Hi everybody, it's AJ speaking. I just wanted to run you quickly through Renault Group's H1 pre-announced figures. So they haven't released the full disclosure yet, but they gave us the key financials early on to basically take off the edge of the blow that's going to come. So what they said is, so the group revenue grew 2.5%, which isn't really all that much if you take off inflation. They reported operating margin of 6.0%, which is actually slightly above global weighted average of around just over 5% in the first quarter. But here's the more interesting number. They report a free cash flow of just 47 million euros for the first 6 months of 2025, and they talk about what significantly negatively affected this. This was an increase in working capital estimated at 900 million euros excluding tax effects, and they talk about what caused it. So what happened is, and they phrased it in an unnecessarily complicated manner down here. They talk about quote, a level of production at the end of 2024 higher than at the end of June 2025. This just means they overproduced in the beginning of 2025, and then this is confirmed in the next bullet where they say, quote, a higher group inventories level compared to the end of December 2024. Higher group inventory means capital consumption is cash flow negative, because you're basically sitting on unsold cars, unsold or unfinished products, more components in inventory, more raw materials. But they, and then the second bullet, they try to, in the second part of the sentence, they try to dampen the blow. And they just say that there was already a positive trend from March to June, because at the end of June, the inventory went down to 530,000 vehicles from 560,000 vehicles at the end of March. But then it gets more interesting, and we jumped over a few things. So basically, then they go on to take down the guidance. So previously they thought they could deliver at or above 7% operating margin, which wouldn't be that bad in the auto industry right now. But now they only expect around 6.5 operating margin. And when you look at the 6% reported for the first half, so this implies they don't expect massive improvement in the second half. And then in terms of total free cash flow for the full year of 2025, they only expect 1.0 to 1.5 billion euros from previously at or above 2 billion euros. And this is where it's really interesting, because when you look at this negative working capital effect, which they should be able to unwind in the second half, so this negative 900 million should turn into positive 900 million, plus the 47 million they already generated. So this is already a positive 950 million, and they guide for the full year at 1 billion to 1.5 billion. This means they only expect around 50 to 550 million in free cash flow for the entirety of 2025. And that would basically imply, because this company is valued around 12 billion euro, that their free cash flow yield was below 5%. And given that, for example, US government bonds traded 4.4% yields at a 10-year, it really doesn't make sense for anyone to buy something like that, this company, over US government bond and take on all the equity risk. Then a couple of things to outline. So they had a really bad month of June, volume slightly lower than expected. Then they talk about increasing commercial pressure. So there's a price war. Commercial pressure means they had to take down prices to basically sell vehicles or run more campaigns, etc. Then they talk about continuing decline in the retail market. So retail market is sales to end consumers. And then an underperformance in the LCV business. LCV stands for light commercial vehicle business. That is, for example, all these DHL delivery vehicles or Amazon delivery vehicles, etc. And then a sharply declining market in Europe. Then they talk about receivables timings. Basically, they couldn't collect as many bills they expected, basically, and causing negative cash flow impact. This is not that important, I think. And then down here they talk about what they want to do about it. They say, in order to take into account the deterioration of the automotive market trends, I mean, it's been going downhill for several quarters, so this is really bad. With an increase in commercial pressure. again, the price wars continue, is basically what this says. Increasing commercial pressure from its competitors and anticipation of the continuation of the retail market decline. Anticipation of the continuation of the retail market decline. So this is quite harsh for this type of press release. And then they talk about the measures they want to take. So Renault Group is pursuing its strict commercial policy, prioritizing value creation over volume. I repeat, prioritizing value creation over volume. This means they will yield market share, or at least is what they probably plan on doing. And then they say Renault Group is also strengthening its short-term cost reduction plan and is stepping up its initiatives on more structural levers. So this typically means they're gonna terminate certain, I don't know, long shot, moonshot projects, sell off some small entities. And the next bullet point is kind of, or next sentence is almost funny. They talk about this plan is mainly based on SG&A cost reduction, manufacturing, and R&D savings. The funny thing that makes me laugh is that this is basically everything. When you talk about SG&A cost reductions, manufacturing, R&D, there isn't really anything left. And then they talk about how they will be sharing details in the upcoming first half presentation. Again, so far they only release these high-level numbers, and that's why when they release the full disclosure at the end of July, you probably should see a relatively muted share price reaction, because the blow has already been taken by pre-announcing these high-level numbers. Here, just a quick look at the second page of this 2-page press release. There's just some corporate talk. There's, in my opinion, nothing of substance. So with that, I hope this was helpful. The reason why I wanted to share this, it gives you a data point about the European auto market, because Renault is one of the main players in Europe. And the key takeaways are that the market is under significant pressure. I mean, we knew that, but it's always good to test your hypotheses, and it doesn't look like it's changing anytime soon. So with that, thank you for watching. See you in the next one. Bye.